Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me, as I do almost every week, Michael Oliver. Michael Oliver is with me more than any other one individual, usually not for protracted periods of time, but very frequently because I so much admire and have valued his work because I found it to be so useful and helpful to me as an investor. So welcome, Michael. Thanks for being with me again.
I'm glad to be back, Jay. Good.
Thank you very much, and I want to tell our listeners, for those of you who have not jotted this down already, it's olivermsa.com, olivermsa.com to learn more about Michael's work. Well, Michael, you have been paying very close attention to the potential for a blow-off in the U.S. T-bond, and you've also been watching the German Bund and the Japanese long-dated bond as well. What are your thoughts on those now? I saw your weekend report, if I understood it correctly. The JGB, the Japanese long bond, has really looks like it's breaking down. Do I have that right? Are we at a major sea change for the JGB?
Yeah, no, I'm watching all three, like three guys in the lineup, okay, and they're all linked together. I know they are. Now, admittedly, the 30-year T-bond is a maturity that's much longer than the 10-year bond and the 10-year JGB. So I also looked at the 10-year T-note, and I ran that in the weekend report. But I get there is a consensus there, and one is that yields were driving lower, absurdly lower. In our case, not below zero, but in the case of JGB, below zero. In the case of the Bund, below zero. Mm-hmm. And that can't continue. Okay, and that in price that converts to upside. Okay, the bond price is rising, the yields are dropping. But in the case of JGB in the U.S. market in particular, it's been a blow-off, meaning you've been in a tube, so to speak, on a price chart, and you've gone through the top of the tube. Like you've squeezed it so much, you just went whoop, right through the top. Meaning the resistance that used to define the angle of the rise of that market got blown away. Mm-hmm. So now you're in a panic upside mode. Now, the problem with that is, historically, I don't care what market it is, price of eggs, price of gold, whatever, anything. When you do that after a protracted bull market, that means you're at the end of the bull market. You're in the blow-off. And when the blow-off ends, you roll over, but you don't roll over gently, you collapse. Okay, so that's the first observation and statement. The JGB, I'm watching all these markets on both an intermediate term basis and a long-term basis, using annual momentum for long-term and some lesser indicators for the intermediate term. The JGB has dropped sharply recently, meaning rates have risen from sub-zero to almost up to zero rates. A very sharp rise, sudden shocking rise, in fact, when you look at the JGB. That has not happened in the T-bond yet, nor in the German Bund. Therefore, if I'm looking for consensus, I don't have it yet. Mm-hmm. I'm looking for the intermediate downturn in all of them, and when I see that, then I'll get on edge for the potential for long-term downturn, meaning that the blow-off is over, we're headed for the collapse, meaning rates are going to rise sharply at that point. Right now, I don't have that consensus. It will happen. It's just an issue now of timing. But in some other markets, there are also some other markets that are on edge as well, and I find that there's so many things on edge right now, I emphasize that word, that it seems to me like there's something going to happen. I don't mean an event necessarily, but at least a market-type event. Mm-hmm. I see it in the euro. The euro surged up recently to 112.50 last week, backed up a bit. If it goes back to 112.50 again, I think it's going to take another leap upward toward that 115 area. And if it does that, it's gone. I think it'll take off, go up into the 120s. That will vastly upset the dollar. Okay, that's one market to watch.
Now the dollar.
The GDX is very interesting. The gold mining ETF that I watch, that I focus on, which is not doing as well as your picks, which are up 1,000%, but it's up 130, 140% on the year. And it has the name, the main gold miners and silver miners in it, and unleveraged ETF. It's trading now just short of 31. It started the year at about 13-something. Okay,
wow.
So it's quite a good year. Okay.
Yes.
If it trades up to about 32.5 this week, or somewhat over 33 next week, I think it's going to explode. And by explode, I mean go up to a target that I've had all year long, and that is roughly around 39. Now, again, we're below 31 right now, and I'm saying we go to 39. That's 26% move from where we are right now. I think that could occur rapidly. Now, when I look at what's going on in the debt markets, I see the S&P doing some things that indicate to me that it might be running out of gas here and ready to pull the rug out from under those who believed that the new highs meant something. A lot of things are sort of gelling at the same time and with itchy trigger fingers. So I'm seeing too many of these, and therefore this chorus has got me itchy. It's got me a sense that something is on edge here, and we might get some very nice violent market action soon across the board, across asset classes.
Right, and one of these, as you call them, major plate tectonics, major plates that are spinning and moving, and like very much, I like to think of it like the geological plates, the continental plates that move very, very slowly, maybe an inch a year or something like that. And you don't necessarily see them, you don't see what's going on, but when they finally reach a certain threshold, then you the threshold, and suddenly, boom, they're there. That reminds me of the picture you had of this of these prices going up in a tube at a blow-off phase, and then. But Michael, really, when you think about it, what would a 1% increase do in the long bond now? I mean, that sounds ridiculous. We should be worried about a 1 or 2% rise in the long bond.
Likely. Right now, we're above the 30-year U.S. now. We're talking. It's like 2.1, 2.15, something on that order. It may get under 2. Okay, in this upside. That would require it go to a new high, and it might do that. Maybe the blow-off is not over yet. I cannot write off the fact that maybe the upside spike is not through spiking. I don't think it has a lot of time left, a month or two at most, if that much. But I could easily see when it turns down from that orgy on the upside in price, that yield could go to 4% rapidly. Now, from something around 2 to something around 4 is a shock. And,
oh, my goodness.
Well, that's the U.S. market. Now, God knows what's going to happen to Italy.
Yeah. Yeah,
okay,
that's right. I mean, the fact that some of those some of those lesser countries, the southern European countries, have such low rates. I mean, it just occurs to me that if we have something like a 2 to 4% rise in the long bond, it's just going to have earth-shattering impact on such a globally leveraged economy that's become addicted to cheap and free money, and even money that they pay you to take. It's incredible.
The last few days, it's incredible to see the Italian yield drop, while the German yield rises. Now, that doesn't happen. Those aren't market forces at work.
No, of course not.
It's Draghi at work. He's trying to keep that Italian yield down, and it's insanity. And the Italian yield's like in the 10 years like 1% or something, and and the JGB is the German Bund is upticking the yield over the last few days, while the Italian has been dropping, which means Draghi is really concerned. He's buying those Italian bonds to support them. And he's panicked, and there's banking situations there we know about. Yes. There's also some political rumblings going on there, because the Prime Minister of Italy is not exactly pleased with some of the rules and regs regarding the banking situation.
Yes.
So it's getting very interesting.
Well, it is indeed very interesting, and what just dumbfounds me is the fact that the policymakers don't seem to think there's any repercussions to defying the natural laws of the markets, and so the misallocation of capital and so forth. Well, not even allowing capital to have price recognition, of course, is what this is all about. With just another minute left here or two, you were talking about the gold shares, the bullion itself. How is that looking? You're still looking at the upper 1400s?
I still think gold is a laggard to the gold miners this time around, which is new for the last 10 years.
Yes.
I think gold still has a target zone of 1470 to 1540, which is far less percent gain than, for example, the GDX going from below 31 to 39.
Yeah.
And at that point, I'd have to reassess, not for a major downturn, but for a correction or a congestion or something of that sort. Right now, I'm taking it in phases. I think the gold's in the first leg of a major multi-leg bull market. So we're not talking about the end of a bull market, even if we get to the 1470, 1540. We're talking about a problem zone, where you might want to do a dance step and step aside for a bit and buy a dip, that type of thing.
Yeah, right. But we'll certainly look forward to having you on to help us foresee that, Michael. You've been so good and so helpful to us over the last couple, 3-4 years that we've been talking to you, and I really appreciate you coming on with us again. Again, folks, it's olivermsa.com, olivermsa.com to learn more about Michael's work. Thanks so much for being with us, Michael. Always a pleasure, and look to do it again next week, hopefully.
And thank you, Jay. Bye-bye.